New world order.
Uh-huh.
All right. Good afternoon, everyone. This is Rich Swerbinsky with the Mortgage Collaborative here once again with the Last Week in Mortgage Today every Tuesday at 2 p.m. Eastern. I'm lucky to be joined by one of our lender members as my co-host to take a look at all the latest things happening in the mortgage industry, the latest news headlines, also try to get a look into the current business climate from one of our leaders within our network. And today I am pleased to once again be joined by Eustace Mortgage CEO, Kate deKay is my co-host. Kate, thanks for joining.
Hey, Rich. How's it going? Glad to be here.
Going good, going good. And we were just talking before we got started here. You guys coming off a record closing month in March. I know you guys had a great year in 2020. Eustace Mortgage based out of the New Orleans, Louisiana area, doing business in other places. But maybe just for a level set, if you could, just a little bit about your organization and, some of the things that you guys got in the hopper right now.
Sure. So, our big thing has always been growth and technology here over the past couple of years. So growth came to us inevitably in 2020, but less of our standard growth plan, which is either acquisitions or obtaining new loan originators that are a good fit for our company, and more so with this crazy refinance volume. We did have our natural organic growth that luckily we always have experienced in the past, adding some great top producers in 2020 and in early 2021. So that's nice to have, see and know that our direction and what we did in 2020 with making sure that ops are flowing with sales, that we kind of kept up as much as we could with our culture and the changing dynamic that COVID brought along. So now it's back to technology and implementing technology, because we all kind of forgot about that in 2020 and had to focus on just making it through, and capacity went to what was the focus, which was our volume, less focus on technology. So we're back on that track and getting our company set up for the future. We're primarily Texas and Louisiana for those that don't know me, and we're a mid-sized IMB.
Excellent. Thanks, Kate. And Kate sits on our board of directors. One of many cool things about TMC, our board of directors comprised of our lender members. And she noted Eustace, a very family company, been around a long time, but a very tech forward organization. Seems like about 13 years ago now, but a little over a year ago, our last conference was in New Orleans a couple Februarys ago, about whatever that is, 14 months ago.
It was the last conference that occurred, right?
It was, yeah. Absolutely. And, it was, I remember all the pre-Mardi Gras parades for a Mardi Gras that never ended up happening were going on. But I remember, one of your top lieutenants, Stephen Barton, co-leading a session with me at that conference about remote work. And we was packed with like 80, 90 people in the room. And I just remember the collective mindset amongst the lenders in the room. The vast majority, I think, many had some underwriters maybe working remote, but everybody was like, we're not there yet. I don't know why. It seems to make sense. Eustace, you guys have had remote work for a long time. And then a couple months later, like everybody forced to do it overnight. So companies like yourself that are, tech forward-thinking organizations were better positioned for last year. And it sounds like you guys had a great year, partially because of that.
For sure. We were very lucky in the things that transpired in early 2020, that really the majority of our staff was already working remotely, or at least kind of that plug and play model. So both of our kind of headquartered locations, so here in New Orleans, and our secondary location in Dallas is really set up for just that, where, somebody can bring their laptop in for the day, hook up to the double monitors or triple monitors, depending on how many monitors you need, and just kind of plug and play for work. So we had set up remote workers even in, our primary location. So it was really a lot easy for us. I know a lot of people struggled with equipment and trying to get all this stuff in. We had, all of our employees were already on laptops, many of which already had setups for monitors at home. We had already kind of gone down the Teams path and doing the Teams chats and all those things. So that made the transition a lot easier. Of course, as you know, we like to have parties and socialize and also be around each other. So that certainly changed our direction and how we interact with each other, kind of to create that family culture. That changed for us with COVID. The remote work was really already in place.
Awesome. And as always, we strive for this program to be interactive. Any questions, comments, thoughts, anything, please feel free to drop it in the chat or the Q&A, and we'll incorporate it into the program. But Kate, let's go ahead and get into it. There is so much going on right now in the mortgage industry. It seems like I've started this show off with that some version of that line for about 9 weeks in a row here, but so much more government or potential government intervention in mortgage lending than really ever that I can remember since, of course, the 07, 08 madness years. There is a bill in Congress right now for a down payment assistance grant of up to $25,000. A lot of speculation and chatter about potential ways the government can intervene to help the inventory issue and the affordable housing units issues that are really burgeoning into large problems here in America. We've got a new CFPB that has been very aggressive in their messaging, the mortgage lenders and servicers, that has put out there the proposal of a foreclosure ban in totality for all of 2021. And then you have a likely to be outgoing FHFA director that is furiously looking to decrease the footprint of Fannie and Freddie amidst all of this, and really contrary to all of this. You know, as he knows, his runway could be running out in his position. I don't even know where to start, but maybe we'll start with the down payment assistance grant, because that's big news that came out this week. I know President Biden, there was no talk, none of anything related to housing in the 9 months leading into the presidential election from either side. And now it seems like every day that one of the headlines related to potential government policy relates to housing. Mm-hmm. President Biden had a first-time home buyer tax credit in his public housing policy stance leading into the election. But now it seems like that has kind of morphed into a down payment assistance grant proposal of up to $25,000 for people that haven't owned a home in 3 years. A lot of other tentacles to that. But your reaction to that story when you saw it break this week?
Look, I mean, I think it's great. I think kind of trying to bridge that wealth gap and make it specific as they did was a really fabulous thing. I also love the fact that they are making it specific at the closing table and not, a tax credit or something like that, because I do think that eliminates some people from having the ability to access those funds and get them back at a later date. So I think the proposal makes a lot of sense as to who qualifies and to the availability of the funds to utilize for down payment, closing costs, and all those things. I think the problem becomes more along the lines of inventory when we're talking about this, because, we're saying, okay, let's add this in, but there's already a ton of demand. There's already too much demand. And so then we're adding this incentive in for additional home buyers to come into the market, increasing demand where we already don't have the inventory available. So I think the problem's going to occur when this comes out. The affordable housing inventory is not there, and it doesn't accomplish what it's trying to accomplish unless they piece it in with how you mentioned earlier, some sort of affordable housing initiative, building initiative to create that inventory. Because without it, I don't see that this takes off. I know it looks about 30% of renters would benefit from this and be able to qualify for a housing payment within that range based off their metro. So, I mean, that's a pretty large percentage of renters that would benefit from this and also be able to afford a mortgage payment versus their rent. But again, where's the 30% in extra inventory? We don't have it.
You make a great point. Like, we're in the housing industry, we're in the mortgage lending industry. On the surface, right? Oh my God, a potential $25,000 down payment assistance grant for first-time home buyers. But you make an excellent point. There already is just a complete dearth of inventory, a total mismatch in supply and demand, especially when it comes to homes that are likely to be bought by first-time home buyers. So you would think, as this bill cascades through Congress, that hopefully is going to get the attention of somebody.
Yeah.
Like, this is good, but it's going to it's going to make some of the problems that are really a challenge with the housing market in America even more challenging right now. And I don't know, I mean, there's been a lot of things talked about to help the inventory issue. In America, President Biden has publicly called on Congress to initiate a bill that would relax maybe some of the zoning laws, that would allow for, cities to zone differently, to build more affordable housing units. There's been, I don't think, nothing from Congress, but just a lot of banter in the industry about maybe some sort of proposal that would give capital gains tax exemptions to people that maybe
Right.
sell investment properties, do something that's going to occupy it. But none of these have any momentum, and none of them are overnight fixes. It's going to be interesting to see how the inventory issue plays out this year.
Yeah, I agree. I mean, we can see the demand and understand that and why it exists. We know people are, wanting to upgrade in housing. They want to take advantage of low interest rates, and the supply certainly seems a little bit harder to figure out because, we have people not moving. I think historically it's a good bit to do with that low interest rate. I mean, we've historically had low interest rates. People don't necessarily want to lose them. It's also a seller's market. So as prices are increasing drastically, although folks selling would also make the money when they're selling, they don't want to purchase at a high either. So it kind of holds them back. I'm sure we have a little bit of the pandemic mixed in. It's a lot of baby boomers that would need to have kind of that move on, quote unquote, downsize, and they probably don't want to have people in and out of their house, and having to deal with selling a home during a pandemic when they're kind of trying to hide out. And then of course with new construction, we have so much in place that's a barrier to new construction and higher prices and extended times from tariffs and whatnot that are in place. So it's like, you think of existing housing inventory and how do you free that up or move that around, but then you just think of trying to create new inventory, and it's just historically low, underbuilt for the last 15 years. And now we're saying, okay, we need to do something, but building materials not there. I'm sure, the construction crews aren't there to be able to do it. So I agree. That's the much larger problem than creating more demand for housing. But I do think that I really like the concept of what they're trying to do and whom they're targeting to be able to become homeowners. It's just, I don't think it bridges the gap.
Absolutely. Yeah. The spirit of the down payment assistance grant, I would agree, right? It is, the people on the fringes that could benefit from home ownership and building wealth that way. And yeah, I could not agree more. But, it could exacerbate the inventory problem. I think the hope, if myself, other absent a short-term fix to the inventory issue, what you said, what is that kind of shadow group of people that want to sell their home but just haven't because of the pandemic? At least locally where I'm at in Northeast Ohio, that have been a lot of people vaccinated, that things are really starting to loosen up, except the homes on the market that hasn't loosened up at all. So I'm hopeful and wondering, is there really this shadow inventory of people, to a large degree that will sell their home, that just haven't for whatever reason, or do those people, again, on the flip side, you're going to be paying up right now, or if you're buying a new home. So the downsize group, that's the group I'd like to see stats on. That's the group I think we need. If there's any relief to this inventory issue, it's the group of maybe older homeowners that are looking to sell and downsize or sell and rent, that would put homes on the market. But what's it like? Just, you're in two, very bustling metropolitan areas, New Orleans, Dallas areas. The inventory issues, are they as bad as they are in Northeast Ohio, where there's just nothing out there right now?
I think it's probably better in some more of our Texas markets, because they do have a little bit more inventory in those areas, room to kind of build, and folks that are building, because Texas typically has been a market that people are moving into. So it's had greater inventory. Yeah, but like, Louisiana, New Orleans in particular, it's just the existing housing inventory. So it's not there.
And I think, to me, part of President Biden putting so much out there related to first-time home buyers, home ownership in general, I think part of it is almost him kind of thumbing his nose in Mark Calabria's face a little bit, who is right now, the president does not have the authority to remove him from that position. That could change per a Supreme Court case that is expected to be ruled on in the next couple of months here. We've seen Calabria now starting to do things to shrink the GSE footprint, no longer buying loans under the not the QM patch or the GSE QM patch after July 1. Obviously, the announcement on non-owner second homes and investment properties can't sell more than 7% of units sold to the, and I think just Fannie right now, but likely Freddie as well. Did you guys look at your pipeline after that came out? How did you guys fall with that 7% thing?
Yeah, that was big news to me. Also news that I felt like should have been out before, because, the P whatever, now I can't even think, the P whatever it's called, that all came out. The treasury bills that they created, seems like, it was out before, when they created this path to Fannie and Freddie getting out of conservatorship. So I'm not quite sure why, seemed like it was announced, and, of course, has to be quickly put in place, but I never quite could understand that. Because obviously they have a plan right now. So could they tell us what the plan is, so we know what the next the next group of loans that they're going to try to eliminate? But yeah, for us, we have a pretty decent percentage of investment loans that come through, and really our strategy was to deliver a lot of that direct to Fannie. Because they have lesser LLPAs. It made more sense for us to retain those. For the loans that we're doing, it's specific groups that we have relationships with, so it's good performing loans. We never had any issues in the past, so we were servicing those loans and delivering them and retaining them to Fannie. So our portfolio is about 25% investment, is about 25% investment, and we're during the pandemic was probably running about 30% that we were delivering of our total mix to them monthly. So, that news for us was very big. It's since seemed to have not be as, I guess, quote unquote, devastating as we thought maybe it would be, which would potentially kind of eliminate that book of business. But it appears the aggregators have come in and they're bidding and securitizing these pools separately. So we had to change our strategy, of course, delivering these loans to Fannie. But those aggregators and investors do appear to be targeting those loans now, and we're still getting a pretty close to the same price. We just don't have that retention.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, joined this week by Eustace Mortgage CEO Kate deKay as my co-host. And the show I do with Rob Krisman every other Friday, The Rundown. Rob says this all the time, and it's something I think we take for granted. No industry, I don't think, in America has been and continues to be just dealt more change on a day-to-day, week-to-week, month-to-month basis that is just critical to how our members and companies like you run your businesses. And, at least in the past, it was telegraphed to some degree, but really, these last couple of years, it has been, no warning, really. Just major things that not only impact companies like Eustace Mortgage, but impact the American housing finance system that are just being dealt, cards on the table, with no prior notice, and more potentially to come too. It's going to be very interesting to see, the P, it's going to be like preferred stock purchase.
Right, thank you.
PSP, I get around. Like there's a lot more in that.
For sure.
That could be coming down the pike. it's going to be very interesting to see, how Mark Calabria and the FHFA handle these next couple months, knowing that, they could be running the end of the road. Former NBA President Dave Stevens wrote a really good piece that was on Housing Wire, I want to say a day or two ago, just outlining all this and, really wondering why mortgage lenders are not more up in arms. When I read it and saw that, my first thought was it really doesn't do any good to be up in
Yeah,
arms.
what are you going to do?
What are you going to do about it? We're mortgage lenders. We adjust, we adapt, and we move on to the next thing. But it's kind of a crazy business climate for a CEO like you to have to deal with, no?
For sure. I constantly think of the Friends episode where, Ross and crew are trying to pull the couch up the stairs in a New York stairwell, to get to an upper floor apartment. And, he screamed, pivot, pivot. And it's like, that's what we have to do, pivot. That's all we can do is pivot and adjust and make the changes that we need to, and have leadership team that understands how quick decisions have to be made when things like this come down to us, and roll with it and problem solve along the way.
The potential foreclosure ban. I know you guys service. How much did that, we have a servicing professionals working group. It's all our heads of servicing that have their own little, kumbaya working group and get together and talk through business strategies. And, I know that it's one of those things, again, on the surface, it sounds great. Oh, no foreclosures because of the pandemic and we don't want to adversely, but there's a lot of unintended consequences to rolling out a policy like that. How did you guys take that news at Eustis?
There is, it's a small percentage of our business. I think, as always, it's hard to deal with the continuous, like how many people can affect and change our business, CFPB, FHFA, who else wants to come up with, a new rule that changes whatever the previous person said, just as we were talking about. So that certainly gets frustrating. Our servicing portfolio is a small portion of our business. And, honestly, I think we only have about 20 or 30 loans total in forbearance of our 290 million that we're servicing. So it's, for us, wasn't a substantial, if they delay it until 2022. I think, for the purposes of forbearance and trying, and even inventory, like we were talking about, of course, I don't want us to have inventory because we have a bunch of loans in foreclosure. But that's certain, if there is no plan or specifics for a person to be able to keep extending forbearance or have a moratorium on foreclosure, it's inevitable, and it's just delaying the inevitable. So I think, just saying that it's going to be a ban until 2022 and allowing forbearance for basically anyone that asks without having to document any reason that they're in forbearance. I think if you just get a little bit more specific and calculated about it, it wouldn't necessarily be a bad thing.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, joined by Eustis Mortgage CEO Kate deKay this week as my co-host, and we've got about 5 minutes left. Kate, let's stay on the topic of just regulatory matters and the CFPB. Obviously, new CFPB in town that has been pretty aggressive in their messaging to the mortgage industry. Particularly, I think they're starting out really on the servicing side, just in line with President Biden's MO about leveling the playing field and disparate impact, not wanting people that have been affected by the pandemic to be booted out of their home as a renter or a homeowner. That I totally get. But I think if you read the tea leaves and talk to people smarter than me, one of the things that's probably coming down the pike for mortgage lenders is once this pandemic stuff is in the rear view, if not before, is more of a focus on fair lending. Being a former depository lender, that is something I had to really keep an eye on. And, deal with. Independent mortgage banks really have not had to this point. You guys are in some very diverse markets, like the New Orleans market.
Yeah.
Do you think about that? Have you made any changes? Do you think about like the climate potentially a year from now where, you'll be forced to, have your HMDA data examined against the demographic data of the markets you lend in, looking for mismatches, looking for signs of disparate impact or any kind of negative impact to certain demographics or groups? Is that something that is top of mind for you as a CEO right now?
For sure. For us, being an IMB, yes, fair lending is a little bit less relevant in that fair lending doesn't keep me up at night. We have, the programs in the background that are essentially tracking and making sure that on our side, we're doing or staying within our means and within our fair lending policies and procedures and tracking all those things. I think the 2021 Act, the $20,000, $20,000 to $25,000, hopefully that helps open up the areas. Because I think for us, it's probably more about specific areas. And again, like talking about inventory. So yes, we monitor fair lending. Of course, I always get concerned when there's a change in a location like the CFPB that comes down to us in a negative way. I always know, for me, we're always doing what's right and what's best. So I find it hard to believe that, I could ever have a problem if as a lender, we're always doing what we believe is right and best, and have the policies and procedures in place that we're supposed to monitor it. But that said, I think that the act that's hopefully going to roll through Congress and the House to figure out a little bit of a different strategy on it, but that maybe opens up some of the areas that we may not be lending as much in, because it's more of a rental, investors and whatnot that are located there. So I think it's taking the right direction in fair lending.
Absolutely. We got just a couple minutes left. Some other topics that are out there. A lot of obviously companies going public, Blend, the latest. We've got just in general a rash of private equity deals into mortgage fintech in general. There's been a lot of that going on recently. We got a new HUD secretary, Marcia Fudge, came out and said no reduction to the FHA insurance premiums. And then, of course, all the madness going on with all the, the wholesale lenders, Rocket and United Wholesale, and that whole madness. Anything in there that draws your attention of that?
Stay away from the whole wholesale drama. It seems like a lot of, propaganda and craziness for stuff that's completely irrelevant to home buyers and helping people obtain home ownership. I certainly think the FHA thing is interesting. It seems kind of the MO that they're really just not going to adjust the private mortgage or the mortgage insurance premiums. It's just not the direction that they're going to take. I think that we had looked at previously, like kind of FHA being kind of the subprime. We always talk about that here. Like, is FHA kind of the new subprime? Pushing, Fannie and Freddie's changes, is that going to push more of those risk categories? So not the investor and secondary homes, but the two risk categories that also can't be delivered direct to Fannie or Freddie. Is that going to push more to FHA and kind of continue that what we've labeled the subprime type product? And I think it does. And maybe that has something to do with why they're not adjusting that mortgage insurance premium, because they see that their portfolio is a riskier portfolio based off of the product, but then it doesn't make sense, because if you don't change it and make the adjustments that you need to, you're not going to get the good business back. Because we all know that, many years ago at this point, it shifted from, you always used to be able to choose FHA or conventional and what made more sense for the borrower. Where now it always makes more sense if they can qualify for a conventional loan to go with a conventional loan. And FHA is just continuing down that path of kind of getting the lesser business, the riskier loans.
so many moving parts right now, and contradictory parts as well, with the essentially a Republican FHFA director, Democratic leaders of the regulatory bodies and HUD, and obviously in the White House, and very, every year is interesting in the mortgage industry. One of the things I like about this industry, it's never a dull moment. But
Correct.
right now, especially when you talk about the inventory and the affordable housing stock issues, and what's going on at FHFA with the agencies, and all these different potential government intervention into housing, if it's down payment assistance grants, like, it is going to be a very, very interesting year for the mortgage industry, coming off one of the best years ever for it. So as
I
always,
agree.
never a dull moment.
I think, I hope that every lender has a nice, fat loan loss reserve, because I still think we have more to see there. Even in conversations with some of our investors about, what loans they're looking at, considering early payment defaults, and many of them are not looking at the loans that are in forbearance. And one even said that they're worried to see what will happen once the forbearance ends and how they'll look at those loans. So that always stays back of mind for me. So make sure your loan loss reserves are nice and hefty.
That's a great note and point to end with. Because I've heard that from others. Stephen Milner,
Yeah.
Stephen of US, he mentioned the same thing on this program a couple weeks ago, that he's getting an inordinate number of QC requests from investors in the secondary market. And, we've seen this movie before.
Exactly. It's taken a long time to get there. And I think people are forgetting that it's still a big risk.
Right. Well, yeah. So yeah, never a dull moment in the mortgage industry. And
It's supposed to end on a high note, though. That was a low note.
exactly. But well, Kate, thank you very much. As always, really enjoy the conversation. As always, the time always flies by, and really appreciate you joining me again this week.
Thanks for having me, Rich.
Absolutely. And to all of our attendees, thanks again for taking the time out with us. Same place, same time every week, 2 p.m. Eastern, every Tuesday, for the last week in Mortgage Today. Until next week, we'll see you. Have a great week, everyone. Take care.
Have a great one, everybody.